Let's do sort of a comprehensive example. In this table, we are given, different items. If you look closely, you will realize that some of them come from an income statement, others from a balance sheet. And we also have the value for each for 2010 and 2011. Question 1. Which items belong to a balance sheet and which items belong to an income statement? Sales, that's an income statement. Cost of goods sold, that's an income statement. So is the interest, depreciation, and taxes on the very bottom. So the first four and the last, taxes, are part of an income statement. Everything in between is from a balance sheet, and that includes cash, accounts receivables, current liabilities, inventory, long-term debt, net fixed assets, and common stock. Question number 2. What is the net working capital in 2011? What is the definition of net working capital? It's current assets minus current liabilities. Do we have current assets here in one line? No. But we know that current assets include three things: cash, accounts receivable, and inventory. So we can add these three up. And then we need to subtract current liabilities. And we already have the value for that. If we didn't, then we would need to add up two items: notes payable and accounts payable. But we already have the sum of the two. So for the year 2011, we add cash, accounts receivable, and inventory because that's our current assets. So 313, 1,162, and 1,521, and we subtract the current liabilities, which is 1,051. And the difference gives us the net working capital equal to $1,945. The fact that it's positive tells us that we have enough cash or things that could be quickly and easily converted into cash during the year 2011 in order to meet our short-term obligations, such as paying back short-term loans or money to suppliers. And the last question, question number 3. What tax rate was used to compute taxes in 2011? Well, we know what the tax amount was paid, right? What tax amount was paid in 2011? That's $670. So what was the taxable income? The taxable income is always calculated by taking the sales revenue, subtracting the cost of goods sold, depreciation, and interest. When we find the four numbers and put them together like this, we get the taxable income of $1,912. So out of $1,912, $670 were paid in taxes. So what percentage of taxable income are taxes? To find the tax rate, we take the tax amount and divide it by the taxable income. 670 divided by 1,912 gives a 35% tax rate. Summary. We looked at two financial statements. We reviewed balance sheets, which show a firm snapshot or a firm at a point of time, how much it has in assets regardless of when they were purchased, how much it has in debts regardless of when they were taken. And we reviewed income statements. That's when we sort of zoom in at a specific time period, maybe a quarter, maybe a year. So it's a firm's performance over a period of time. And then lastly, we reviewed what we mean by cash flow from assets, also known as free cash flow. So the word cash flow indicates money actually either spent or received. And so there is a special item that came up in this chapter known as depreciation, right? Called depreciation. And depreciation is known as a non-cash item because it's only there in an income statement for tax purposes. It doesn't necessarily reflect how much money was spent. So cash flow from assets that assets generate in sum here are then split between the two groups of investors that provided the funding to the firm by buying by lending the money to the firm and buying the firm's stocks. That's creditors and stockholders. So cash flow from assets equals cash flow to creditors plus cash flow to stockholders. And in Chapter 10, we will look at cash flow from assets in more depth.